Hi, my name is Alli Varnes, UNE SRI's US-based expert in residence for 2020. This is the second half of the workshop I presented in March called Dealing with Investors Part 1, Managing the Entry. In the first half, I covered the various investment options available to you, laying out the pros and cons so that you can measure each of those up to your own business. In this video, I'm going to do a deeper dive into one of those options, which is securing investors. And as always, I'll strive to share my own personal learnings, having had a tech startup for almost 10 years that secured several rounds of investment capital before it was acquired last July. So, kicking off, dealing with investors, there is really three types of investors that you're going to be looking at, especially from an early stage standpoint. You've got your angel investors, your VCs, and your strategic investors. So the angels are primarily high net worth individuals, basically people with a lot of money. And these are people looking for a better return than they would normally get through the stock market. So they've got a little bit of disposable income or a lot of disposable income, and they'd rather put that into an exciting startup than put it into stocks. So then you've got your VCs, your venture capital funds. These, I think most people look at these as kind of the holy grail of investors because they tend to come with big checks. But I do caution that not all VCs are created equal. So supposedly they have the most power to fuel success. And so it's, really exciting to go, a VC is interested or we're talking to a VC fund. But I do find that it's not always the case. And it can often be very exciting to have some sort of interaction with a VC, but there can be time wasters. So, especially in the early stages or kind of the earlier years of our business, there were times where we would get a LinkedIn message from someone from a VC fund or an investment fund, and it would be quite exciting because you don't know how they came across you. Maybe they saw you in startup media or at an event, but it's kind of like dating, like, oh, the popular guy wants to talk to me or the popular girl wants to talk to me. But we did find that there are a lot of deal screeners who work with or within VC funds, and it's their job to go out there and talk to as many businesses as possible, get them all through the door so that they can find the best ones and pick out the cherries. So do beware of time wasters. You are incredibly resource scarce as a founder, and you don't have a lot of time. So just beware that you're spending your time with serious investor interests. They are actually interested in your business and they are a good fit for you or potential good fit for you. So you really need to kind of step back and assess them as much as they're assessing you. Sometimes it is tempting when you're raising a round of capital to just scattergun and be prepared to talk to anybody who might be able to write you a check. But you do want to consider things like, especially with a VC fund, the timeline of their fund. So did they just raise a big round of money that they're looking to dole out amongst a certain number of businesses, or are they at the end of that fund that they've doled most of it out, but they are looking for the last couple of investments to make? What is their interest? Do they have an expertise in a certain field or a certain type of business? Do they actually have power to get you to the next stage? Are there similar businesses that you could partner with already in their fund? Or do they come from backgrounds? Do the partners who are actively working within the fund, do they have expertise that you can draw on that can fill a gap for you? And most importantly, how do they treat their founders? And how do they treat their investments generally? There are some who it's the people who are part of the fund have actually invested their own money. So you would hazard a guess that they might be a little bit more invested than someone who's just playing with money that's not theirs. And so there's all different types of things that you want to consider when you're looking at VC funding. Not to say that it's not something you should do. Absolutely talk to VC funds. They're not all created equal, like I said. And then your third type is strategic investors. More corporates are starting to take an active interest in early stage companies. I think in the last, say, 5 years or so, I've seen a real, upward swing towards more corporates actively trying to engage at an earlier point, I think, again, beware. You really want to ask yourself, is now the best time to be opening yourself up to what could be a potential acquirer? That's traditionally, a strategic investor might come in on day one and say, look, I'm prepared to invest X with the plan to eventually take over the whole company if you were to hit these milestones. At one point in our journey, we had that opportunity on the table with us for a big strategic, and at that point, we decided that it wasn't the best move for us. We wanted to grow a little bit further, develop more of the technology, hit some more milestones before taking on a strategic investor, because once you do that, it can start to it really can limit your exit opportunities, if that is your plan. If you're planning to sell your company one day, and you do a deal with a strategic, that's going to lock out some of, obviously not some, but probably all of their competitors. So it is a big decision to make. I would also lump private equity firms into this category because they are also going to be the ones behind majority stakes in the companies that could be a strategic investor. And while it's good to be on their radar, you want to try to avoid sharing your secret sauce. And that can be a really difficult dance to get right, of getting them interested, being on their radar, but not telling them everything that you're doing so they can just imitate you. And that was always one of the big questions we always got when talking to any type of investor was, well, what's going to stop this existing corporate in the market from doing exactly what you're doing? And our answer was always, well, it would be easier to buy us than to develop the technology themselves. But that's going to be different for all types of businesses. So those are the three types. Diving into angels, most angels are going to be looking for people. So they want strong founders and a strong leadership team that will be able to not only execute on the business plan, but also weather the storms that might come as they grow that business. So it is a roller coaster, and they need to know that you will have the passion and the skills to ride that roller coaster and take the business through to scale and grow. So traditionally, they're also going to be looking for a business plan. Now, in my experience, with about 20-something different shareholders, not everybody actually wants to read the business plan. They just want to know that you have one and it's convincing and complete so that you can talk to it when you have a conversation with them. Some will actually want to get a copy of it and go through it in fine detail. So that's all down to the individual investors. And again, the different types. So you're going to need, financial projections, marketing plans. They want to know, everything there is to know about your target market. And they want to make sure that they see a developed vision that has detail to it in terms of how you're going to grow the business and stay competitive. They're obviously going to be looking for a company that is also structured for investment. So do you have your shareholders agreement? Do you have, legal counsel? Do you have everything that you need to have set up so that they can, write you a check, basically? And again, they're going to be looking for a better return than they would normally get through the stock market, ideally. In terms of investments from angel investments, 40% of angel investment exits in 2017 provided investors with more money than they contributed. So for every dollar, this is a quote from Alan Riding, who's a leading expert on angel investing and a professor at Carleton University. He said, for every dollar that an angel puts into a company, he or she would like to take $7 out after taxes in 7 years. So not, science necessarily, but I think this is just really helpful in terms of measuring or understanding what an angel investor's expectations will be coming into your business. Now, angel investors, there's going to be three types of those. So there's the hedonistic, the altruistic, and the economic. A hedonistic angel investor is most attracted by the excitement of creating something new, disruptive, or fun. So they're in it for the thrill. An altruistic angel is mostly concerned about helping his or her community. So they want you to pull on their heartstrings. You're doing something that's going to make a big difference to the community and a community that they care about. And then you've got the economic or the entrepreneurial angels who tend to invest in a greater number of companies. They tend to take more active roles in the companies that they invest in, and arguably they tend to earn a better result as a result, a return as a result of that. So you, being the founder, should think about what type of angel investor you're looking for, who are you going to most likely attract based on who you are and who the business and what business you have. Ideally, you want to write a pitch when you're working on your pitch that would speak to all three of these. So, pull the altruistic angel in with your, anecdotal stories. Speak to the hedonistic angel investor by how exciting, disruptive you are, but then really nail down the economic or the entrepreneurial angels by knowing your numbers and demonstrating that you've got a believable plan to achieve the goals that you're outlining. So where do you start? How do you connect with these people? These are high net worths. They tend to, if they are interested in investing, they're going to be part of startup and business networks. They're likely to attend pitch events, be part of an angel investor group. They might also, dance around accelerators or be part of incubator programs as mentors, or, they might just attend the events. My number one source was always lawyers, accountants, and advisory firms. So investors are always keeping an eye out for prospects. They are using their own networks to help them find opportunities and also to help evaluate those opportunities. So what you want to do is just make it easy for them to find you by getting out there, networking, and not being shy about sharing what you're doing, and ideally sharing what your KPIs are, your key performance indicators, because if you're dropping in conversation, we doubled our revenue month on month this year, or we hit our expectations last quarter. If you have plans to expand, share what that would mean to your profit, or you're talking to partners who would, double your user base in the next quarter. I think what I recommend is be a little bit vulnerable. Share those. And don't be too humble. So getting out there, networking, talking to people, sharing more about what's exciting about your business. You never know who might perk up and go, oh, that's interesting. Tell me more. I'd love to talk to you more. Are you looking for investment? It's amazing how much will come out of that. So there's times where I've sat in client meetings and someone you would never expect in your wildest dreams to be interested in investing in your business would say to you, had said to me, I would love to get involved in your business somehow. And I think with the knowledge and the media exposure of startups, and more and more people are aware that this is an opportunity for them. So don't discount anybody as who could be a potential investor. The other thing I might mention too is you might be too small of a company at this stage for a private equity firm to be interested, but their people are usually on the lookout for their own investment opportunities. So it's not always a bad thing to talk to the partners or directors or the people who work within a private equity firm, because they, as individuals, could be an investor in your business, while the PE firm might not be. So the golden rule, then ask for money and you'll get advice, ask for advice and you'll get money. So again, kind of getting out there, talking to people, asking for their feedback, oftentimes that just breaks down the barriers and breaks the ice for you to forge a better relationship with someone who could potentially be an investor in your business. So just I think, especially when you attend those startup events where, it's kind of matchmaking, they've got a number of VCs there and they've got a certain color name badge, and then you've got the startups with a different color name badge, and everybody wants to swarm the investors. I think the way to stand out and the way to actually forge a relationship with people who are interested in connecting to startups and investing in them is to ask them for their advice. I'm working on this challenge in my business and I'd really appreciate your feedback on it. Or even as simple as I'm preparing to raise a round of capital. I would love your feedback on my pitch deck. I know you might not be interested, or you could be interested. At this stage, I'm really just forming, getting ready to raise the money. So I would love your feedback. And again, that's a great way to just kind of lower defenses and get through and start to actually talk to people. So again, yeah, ask for money, get advice, ask for advice, get money. Next, find your lead and the rest will follow. So the hardest part of fundraising I found is securing your lead investor. So that's not necessarily the person who contributes the most money. It's the person who first agrees to your terms, does due diligence, and makes a commitment. So it's basically your first check writer who goes, yep, I agree with your valuation. I think you're onto something. I believe that you can do it. Here's my money. I'm in. Once you have that investor, it's much, much easier to secure the others. Investors, in my experience, like to follow others because there's, that kind of safety in numbers mentality. It takes a pretty brave investor to be the first one to say, yes, I believe in these founders, their vision, and their ability to execute, so I'm prepared to put my money in. There's, time and time again, that was the linchpin that either meant we raised the money or we didn't. There was the one round that took us the longest. It was the hardest because we couldn't secure someone to say, yes, I agree with your terms. Yes, I agree with your valuation. It was a dance with, I swear we probably met with over 50 people. Lots of them would say, yep, I'm interested. Let me know when you secure your lead, or come back to me. And then sometimes when we went back, it was, no longer interested. So find your lead investor and the rest will follow. Don't be shy. So I kind of touched on this previously, but like I said, investors want to invest. So you want to make it easy for them to find you and to follow you. They're out there, they're using their own networks. So you just want to be in those networks, talking to the same people ideally, and sharing information that would get them excited and make them want to talk to you and find out more. If you do meet somebody who could be a potential investor one day, or could be a connector to an investor, ideally create some sort of business champions group and keep them updated with your progress in terms that an investor would understand. So one suggestion, this is something that we didn't do early on, but I kind of wish we had. Create that group either in some sort of email marketing campaign system, or maybe just as a simple group in your email that you send a quarterly email update to. And it can just be, here's a couple of bullet points of, our achievements this quarter. It's good practice for you to sit down and go, what have we achieved this quarter? And actually write that out. It's also really good practice for when you do raise a round and you need to keep your shareholders up to date with the latest company news. So it's just good practice. You do want to be careful in that respect, not to overpromise and underdeliver. So it can be very tempting to announce new relationships or a potential deal, or just generally be excited about something that is in the works or you think is on the horizon. But you want to be really careful about what you share, because you don't want to risk your reputation. If that quote unquote sure deal falls through because of something outside of your control. So there is a bit of an art to investor relations, and it can be hard to get right. But the key is to keep people interested, tell them things that are tangible, that will keep them excited about what you're doing. And they might, again, come out of the woodwork and be someone who says, you know what, I am now interested. You hit that, whatever it was for them, that key milestone, and now they want to talk to you about investment. So something I heard time and time again from a couple of my mentors and investors was take them on the journey. You want to operate from that perspective that all of your investors and your potential investors are interested in your journey. Assume that they want to know what's going on and they want to ride the roller coaster with you. So you don't be afraid to be vulnerable if you are dealing with challenges. Put that out to them, again, ask for advice. And you could say, here are the key milestones that we hit this year or this quarter, or since the last time I emailed you. And these are some of the challenges that we're working through right now, and do an ask at the end. Don't be afraid to put an ask out there and say, I would love advice about franchising, or I would love to talk to someone about how to scale my marketing campaigns. Whatever it might be that you're dealing with, put it out to that network and you'd be amazed at what might come back your way. So where to start? I kind of, again, went through that list previously. Something I just want to caution about is being aware of connectors, people who are out there offering to connect you to investors. They can often waste your time. They might not necessarily connect you with the right people, and then those meetings can take up a huge amount of your time. We formally worked with connectors about 3 times in our 10 years of startup world, and there was kind of one who was a strategic connector, just a smaller operator. Probably we wasted the most time with that guy. He, because you're not only convincing, you're kind of selling the opportunity to him or her, and then they are then connecting you to people in their network. So you're kind of selling it multiple times over and over and over again, which can be really time intensive. And in that particular case, we spent hours with a couple of the investors that they connected us to. And the outcome was they weren't prepared to agree to the terms. And they actually offered us kind of half of what the value and the money we were looking for, and it just wasn't a good fit. And we also worked with an investment bank that described itself as specializing in corporate advisory, raising private and public equity capital for small to medium Australian companies, and arranging debt facilities for mid-sized companies and direct investment for companies prior to a float or a public offering. And again, that was really attractive at the time because they were basically offering us access to their entire network of investors, which was much larger than the one we had. And they were, going to help us refine the pitch so that we were delivering a pitch that would definitely speak to their network. But we spent 9 months with them working on the pitch, meeting with people, and to no avail. We did not wind up raising money through any of the people that they connect us to. And that was for us at that point in our business, a huge waste of time. But then, the third that we worked with and the final one that we worked with was an accounting and advisory firm. And we managed to raise the round that the previous investment bank was not able to raise, but they did. And I think it was just a matter of the quality of their network, maybe also the way that they sold it. So just a cautionary tale, I guess, in our experience working with connectors, it can be attractive because you think it might save you time and in terms of connecting to a network and getting the pitch right. But in our experience, it actually was the opposite. So I think it really just comes down to the people. Can they actually walk the walk? And again, references are a great way to kind of establish that, do a reference check with people they might have worked with before. And then the other thing I just wanted to caution here too was being aware of equity for work deals. Sometimes they're formally offered through like an established accelerator program that maybe lends their dev team to help you build your MVP in exchange for equity, or a custom deal with a developer who is also a shareholder. You just want to make sure you're protecting your investment by owning your IP or having a very clear agreement about what your unique IP is and what is not. Because sometimes there have been cases where we looked at deals like this, especially in the early days when we didn't have our own CTO and our own tech team to build the platform. We talked to a group who offered their dev team to help get you off the ground in exchange for equity. But in the very fine print of the agreements, it meant that we didn't own all of the IP. And that was really important to us because from our perspective, we wanted to own everything so that we could sell it one day because we had the intention of selling. So just being aware of a couple of those things in terms of looking for investors. I think I touched on this in terms of VCs, but not all investors are equal. So just remember that you do have a choice and to choose wisely. Some investors think very highly of themselves and they want more or a better deal than other investors coming in at the same round. We had to say no to certain investors because of that exact thing. A couple of times in our years. Some investors come with connections, some don't. Some promise connections that then don't fulfill on those connections. You might assume they have connections that they don't actually. If they've come from a company that you think might be a good strategic partner or investor one day, don't make those assumptions necessarily. Just because they worked there doesn't mean they have either still good relationships or they would feel comfortable even connecting you. Some investors can reinvest, some can't. Again, not necessarily good or bad either way, but just being aware of those. You really want to assess investors as critically as they're assessing you as an investment. And that can be hard to do if you haven't left yourself enough time or you're desperate for cash. It can be hard to say no to money. But in the long run, you're probably better off saying no to the wrong investor than taking money from the wrong investors. Ideally, like I've mentioned, get references if you can. Contact founders of other startups that they've invested in. Ask them for references. They're probably going to ask you. I know there was multiple times over the years where investors looking at us as a deal wanted to talk to a client, which can sometimes be a bit confronting because your relationships with your clients might not be allow for that. Luckily, I had clients that we could provide as references because, they're doing their due diligence on you. And so it's just, it's as important for you to do your own due diligence on them. Because if you get a bad seed, you could find yourself in a lawsuit or closing the business. And I had a acquaintance through the startup world who wound up having to put her company into administration because of shareholder disputes. And she, I think she wound up actually buying the business back, but it was a distraction. It was a nightmare. So you just want to, the more time you can give yourself to raise the money you need, the more choice you'll have at the end of the day. So you just want to give yourself the best possible chance of that. So the big question, how much do you raise and at what value? It's probably one of the hardest parts of raising money. The careful balance of equity and cash is not always easy to come up with. So how much? You definitely want to raise more than you think you need. When it comes to valuation, it's definitely more of an art than it is a science. So just diving into the how much question, you really want to calculate what you need in order to reach the next major inflection point because and entrepreneurs are inherently optimistic, right? So we think, oh yeah, I can get to here with just that money, but you definitely want to raise as much as you can and understand that your monthly burn is you need to know what your monthly burn is, map out your company's important timelines and the cash that you're going to realistically need to achieve them. Because what you don't want to do is go through all of the effort of raising money to run out before you actually deliver on the promises that you sold to your investors. So you want to think like an investor, do a sensitivity analysis. What if the company can't find, that key employee that you need to deliver on that goal? What if you're delayed in launching your product? What if you can't start charging yet and your income, that you thought you were going to have doesn't materialize? What if people aren't willing to pay what you expected them to pay? What if your product needs to pivot? What if a deal falls through? Something that you think is absolutely set in stone, just it never is. It never is set in stone. So just prepare for the worst. And I think you need to add at least 6 months to the amount of money you need for your next major milestone. so that you've got that 6-month period of, all right, we're not, all of a sudden going to be out of money and can't pay our people. You have that buffer. You need to consider how much equity you're prepared to part with and what it might mean for future rounds too. So just as a cautionary tale too, along with how much, we raised one of the hardest and largest rounds only to be hit by a series of completely unexpected setbacks. Like I think we raised it in 2 different tranches, which means we got the first lump of money, and then about a month and a half later, we got the second lump of money. And almost as soon as we got that second lump of money, we all of a sudden had this trademark issue, and wound up having to sell our trademark and our company name and change our company name, which we were not expecting to do at all. And it was kind of and then we lost our mobile developers in rapid succession. We couldn't find replacements for them. We hired a new BDM who struggled to get on her feet, and then she quit. As soon as she started to actually get some sales in the door, she moved on to another opportunity. It was just kind of blow after blow, and none of it was expected. So it was a difficult point in our business's journey. So I caution you to raise more than you think you're actually going to need. But obviously you need to balance that against the equity you're prepared to part with. So valuation methods, there's a number of ways of coming up with a value for your business. The most obvious and most kind of the one they teach you in business school is a multiple of your earnings before interest, taxes, depreciation, and amortization. So 3 times your EBITDA generally is the general rule. Most startups do not use that method because you have no earnings traditionally. So a lot of startups will look at cost to duplicate. So how much money would it take for someone to try to copy what you're doing? Most will also look at a market multiple. So, what values did similar companies get in the market with recent acquisitions? Compare that to where your business is and, come up with a value. And then you can also do a valuation by stage. So traditionally, I've got a little table off to the right-hand side there. And again, this is all not a science. So it's much more of an art than a science. But there's a little table you can kind of look at and then use a combination of those valuation methods to come up with a number that you feel comfortable, that you can back up, and that you feel comfortable negotiating with an investor over. So they might not see eye to eye with you, and you just have to back that up or be prepared to negotiate on the value. So do the math and keep doing the math. I advise keeping an extra cap table that shows any potential future rounds you might have to do, and also a future exit that you don't share with people. It's just something for you and maybe your co-founder to keep an eye on and play with scenarios, because you want to look through and go, are you actually better off not raising that next fundraise and selling sooner because you will walk away with more? Or are you better to raise that next round, reach that next inflection point, and then seek a sale? Or again, continue that dance of Series B, Series C, Series E, D, F, whatever it might be. You just want to keep doing those numbers to make sure that you don't kind of go past a point where you look back and go, I should have sold 5 years ago because I've now given up 90% of my equity, and I now have to sell for this astronomical number in order to get the return I could have gotten 5 years ago, having had more of the equity. And you just want to do that math and know where you're hoping to end up. And the number you're happy with today might not be the same number you're happy with tomorrow. So things change, and give yourself that room to keep considering your options. So when to start? When do you start raising money? And the answer is before you need it. And again, can be very difficult to get right. If you do it too soon, you might not have established enough value to even get investor interest or protect your equity. If you do it too late, you can risk not securing the funds in time, and either you run out of runway and find yourself in a position where you're putting, yourself at even more personal financial risk, or maybe you have to cut costs that put the business at risk. So if you really think that investment is part of your overall business strategy, then you should always be courting investors so that when you do need it, you have people and connections there where you can put the call out, and you give yourself more room to ensure you're getting the right investors so you don't lose the freedom of choice. And you just don't want to take money from the wrong investors, because that could be your downfall. So you really want to do it before you think you're ready. These are the traditional stages of investment. So if you're an early stage business, you're really looking at pre-seed, seed, early stage. Ideally, you hit break even before you get out of the seed stage and into early. And Series B is kind of when you're going global, you're trying to attract better talent, you're really starting to scale and grow. So you're really looking at angels, family and friends, you're really laying the foundations of your business, and then you get into kind of Series A and then B, where you're taking money from more kind of VC funds, you're doing M&A or strategic investors, and you're really using that money to scale and grow. The investor ready test, in my eyes, is you're in market, you've got an established product market fit, you're growing your revenue, you've got proven repeatable conversion metrics, a clear burn rate, and a very clear view to your next inflection point. So there's nothing more impressive to an investor than demonstrating, if I plug your $25,000 into this well-oiled machine, we are going to go from X to Y. And I know that because we've already done it in a smaller way. So the best time to go fundraising is right before or shortly after you've successfully completed a key milestone or a series of key milestones. Shortly after achieving a key milestone is a good time to try and convince investors, because you've effectively accomplished a major thing like launching a product, which de-risks the investment for them. But they can still get into the company before it, quote unquote, takes off. So this is kind of a ideal situation. If you could tick through all of these things here, it's perfect. But it's not always possible. So in our case, when we started our business, we bootstrapped the first year and a half. And after the first year, we realized we were onto something, but the product we had built wasn't going to deliver on what we needed it to. So we had to kind of throw out that revenue model and the product itself that we had built and start fresh with our learnings. And so we were really raising money off a concept. And that is one of the harder ways to raise money. You really have to do a lot of convincing to your investors that, this is what we did. We've already kind of failed in this model, but now because of those failings, we know what we need to do, and we need money to do it, because we've now, we put our money into those initial failings, and we need more funds to be able to deliver on the next vision. So it's not, you don't have to tick through all of these, but if you can, you're in one of the best positions to start raising money. Really good practice to regularly review and update your business plan, and then support that with a weekly cash flow. This was something that one of our investors had asked us to start doing, a weekly cash flow early on. And initially we thought, we don't have time. We don't know what's going to happen around the corner. We're still figuring out what our revenues, are supposed to be, where our projections aren't super accurate. We didn't feel comfortable with it. But I'll tell you now, as soon as we started doing it, I felt so much more in control and just more comfortable and confident in our position, because I knew exactly, we couldn't always predict, because it was a subscription-based platform, when people were going to drop off or come on, and we knew a certain amount, but there was that kind of gray area that we didn't have visibility over, so it kind of just made us uncomfortable. But if you are doing this, that where you sit, so you can make a decision about, does your year's objectives include raising capital, or can you deliver on your objectives without raising extra capital? Do you have a plan B and a plan A and a plan B? If you get the cash, great, but what if you don't? So what's your plan B? Or what if you don't get the amount of money that you are hoping to get? what does that mean? How much time are you going to actually devote to raising capital versus building the business? And that is also a very hard dance sometimes. Because you don't always know. You think, oh, it'll be a couple of meetings a week, but then all of a sudden you find yourself in, more meetings with potential investors than you do getting clients on board. And so what does that mean for the business long term? And just give yourself that room to explore those scenarios. Is the best thing for you to raise capital, or is it to build the business and then look at raising capital later? I think, especially in the beginning years of our business, the whole tech startup boom was just happening in Sydney. And it was like everybody's eyes were full of stars looking at, oh, we can start this business and we can raise money for it. And raising money is still used as a major metrics as to whether or not your business is successful. But really, at the end of the day, a business is successful based on how much money it's earning and, the profit. So I think sometimes it can still be attractive to go, oh, well, I've raised $1 million round. Look how great our business is. But then that business isn't really fulfilling on revenue goals and community sizes and et cetera. So I think it's not a given. Whereas I think people go into raising capital as, oh, it's something I have to do as a startup. I have to raise capital, but you don't. And something else to just think through is who is actually going to take the lead on raising that round. Are you a solitary founder, or do you have a co-founder? Who else is going to be involved? Do you need to, get, help with your pitch deck from your design team? Do you have employees that somehow need to help you? Just thinking all of that through. So I think an annual review of your business plan isn't often enough sometimes, especially in the early days of a startup when things are evolving so rapidly. But just have an overall business plan that's short and snappy. Don't take too much time on it. I would suggest having a more detailed annual plan with objectives and key results that you can kind of track yourself against. And then in my experience, having a weekly cash flow that goes out at least 3 months, as well as an annual or a monthly budget, just gives you that confidence to know exactly where you are. So if you don't raise that round, you know where you're going to wind up. And if you do raise that round, where is it going to take you? And it also is very impressive to potential investors to have that. So what do you need if you're going to raise money? You definitely need a non-disclosure agreement. Again, not everybody's going to sign one. So a VC might say, nope, sorry, not going to sign your non-disclosure because I talked to way too many people and too many different businesses. But it's good practice and demonstrates that you have that kind of business nous to have one and to send it across to somebody before sharing too much about your business. You're going to need all of your round documents. So a teaser, ideally, a 1-pager, a pitch deck, or an overview of the investment opportunity. And then you're going to need a term sheet and a subscription agreement. So a teaser is just kind of, if you have your pitch deck, the teaser and 1-pager are just cut down versions of your pitch deck. Sometimes your teaser can be 2-3 slides of your pitch deck. That's just going to whet an investor's appetite, and then you need to be able to quickly follow it up with your term sheet. In our experience, if somebody was a potential investor who we'd maybe already had a couple of conversations with, we'd send them the pitch deck with the term sheet to say, here's the overview. We've already had a few conversations. If you're interested, we're looking to get the term sheets back by this date. So again, kind of treating it like a sales opportunity. You want to have a clear close. Now, you might put a round end date on your term sheet, and that's kind of arbitrary because, I don't think we ever really closed a round on the date that we set out to, but it gives everybody a sense of, we are trying to have a closure on this within the month or whatever it might be. Due diligence folder. So this is just, again, good practice. It's going to have all of your round documents in it. You will have a copy of your business plan and your budget, your things that you're happy to share with potential investors, your shareholders agreement and company constitution, any major contracts and agreements, your employee contracts or your contractors agreements, and you have your cap table in there too. So again, good practice for us. We kept this digitally. It was just the easiest way to share it with new people is just here's a link. We provided you access to our virtual due diligence folder, so they could access all of this, and you can also just maintain who has access and who doesn't, as you talk to different individuals. And then I think you also need support people who are going to handle, file, and distribute all of the required paperwork in a timely manner. Don't assume that you can do it yourself. I think sometimes it is really worthwhile getting somebody who knows how to, issue share certificates and make sure all the paperwork's filed appropriately and in time, and then distributed back to your new shareholders in a timely manner. It can be easy to go, oh yeah, I'll get to it. And then you find months down the track, you still haven't gotten around to issuing the share certificates. So that's kind of my checklist of what you need. Then you also, ideally, your pitch is something that everybody always talks about. I think the elements of a good pitch is that it's emotive, it's succinct, and it's targeted. Everybody's going to have a different opinion about whether your pitch deck is good or bad. But if especially if your business is continually evolving, which in my case, in my experience, in my case, startup businesses are always evolving. You're going to always be refining your pitch. You have your checklist of things, and if you're in the SRI program, you probably already know this very well. But you want to include the problem, your vision, your approach, the solution, the team. Why now is important. Your total addressable market, the traction metrics that you can share, milestones and projections, who else is in the competitive landscape, and details about what your fundraise if you've gotten to that point. So I won't belabor these points because I think you probably already know them well, but happy to talk through or give my feedback on a pitch if you want to send it through to me. But again, like I said, everybody has an opinion. We got to the point where we just have to go, we're happy with it. It's going to get us the conversation, because the conversation is what is going to either raise you the money or not. I never found that my pitch deck was, make or break in terms of whether somebody was going to invest in the business. It was make or break in terms of whether I could get enough of their interest to speak to them further, but it was never, I'm not investing based on your pitch deck. So it's just about getting their attention and getting to a conversation. And then something I just want to caution is when the money hits your account, if you do raise the fundraise that you're looking for, resist becoming Oprah. So, it's very tempting when you do raise a round to go, you get a raise and you get a raise and here's a little bonus for you. And let's do that little marketing campaign that we wanted to do. Ideally, you're spending the money according to the plan that you sold to investors, but sometimes it can be difficult to not let your money go a lot faster than you think it will. So it's definitely important to celebrate your wins, but just be careful about giving out raises and splurging too much, because money will go so much faster than you think. And if you use your investment money to increase your burn rate, especially in a way like salary increases that you can't easily pull back from, you're just setting yourself up that you definitely need to be hitting the milestones and the targets and the revenue targets that you are hoping to, because your money will go faster, and then you're going to be out there fundraising again if your revenues aren't keeping pace. I don't know if my GIFs is playing for you, but yeah, my little Oprah GIF. And then one of my final points before I close off this part of the video, never forget that you are an investor. So ideally, you want to get the money back that you've invested and the time that you've invested and then some. So there's the exit to keep in mind. Keep doing the math, like I said, but not just in terms of an exit. You also need to be paid well. So some investors think that founders should be paid, the least amount in the company, and to a certain extent it can be true, but it's debatable. In my opinion, you should be paid well enough that you can reinvest in the business later if you need to. And protect your investment. So get the right people around you. Avoid the temptation to cut corners and do everything yourself, because, we were in business for 10 years. There are times when resentment crept in, and maybe mistakes could be made, things might be forgotten. You just don't want to rely on yourself to do everything. You want to get good legal advice, get an accountant behind you that knows what they're doing and can advise you. It can be sometimes hard to find people who are familiar enough with the startup world, so get recommendations from the people in SRI, other businesses, other people in your community that can recommend someone who knows what they're talking about. And the other point I always want to make to other founders is practice self-care. What happens if you aren't in the picture anymore? If you're running yourself ragged, trying to do everything yourself, or pushing yourself really hard, and that can be much easier to do in the early stages because you're so excited about starting up this new business. But what happens if you burn yourself out? Does your business still grow? Investors are investing in the founders, so you need to invest in yourself. It's exciting and your motivation is at its highest in the beginning, but there is no medal for hardest working or most sacrificed. At the end of the day, try to remember that there is life outside of your business, and it's just as important. And it's just as important, and a successful business doesn't require a self-flagellating founder. You are an investor. Protect yourself, protect your own investment, and just keep that in mind as you grow. And then I put these questions up in the first half of my workshop, and I just wanted to end with them again. I just think it's good to constantly ask yourself and keep these questions in mind. What kind of business do you actually want? Where do you want this business to go? Why are you in business? And when do you want to exit? I think sometimes your answers to these might evolve as your business evolves, so it's important to keep coming back to them. Maybe they're part of your annual, strategic planning session, just for your own, compass direction. You just want to make sure you're on the right path. So that's it for this video. Presenting part 2, which is managing the exit, in June. So I'll be back again to deliver that. But feel free to connect with me. Very easy to connect with me through email, which is up on the screen, or through my LinkedIn profile. And I wish you the best of luck with your businesses. Thank you.